Hello everyone. Welcome to Finance and Accounting Academy channel. I'm Dr. Bharati Sunil. Have you ever wondered why some people earn consistent returns from investments while others face losses? The secret is not luck. It is following a proper investment process. So in today's video, we will learn the complete investment process step by step from setting investment objectives to portfolio revision in a very simple and practical manner, which is useful for students, investors, and who are preparing for competitive exams. So watch this video till the end because this topic is very important for investment management, MBA, BBA, BCom, and also for real investing. In today's video, we will discuss what is investment process, investment policy, analysis, market, industry and company, valuation, portfolio construction, portfolio evaluation, finally conclusion and key takeaways. First, we will discuss what is investment process. In investment process, we'll follow a systematic method before we select some suitable investments. So what is the process we adopt in selecting suitable investments? I will explain today. So if you follow this investment process, it will definitely minimize our risk and maximize our returns. And this investment process will also help us to invest for long-term purpose, to fulfill our long-term financial goals and also to create our wealth. This investment process includes investment planning, analysis, valuation, diversification, and review. So, with this, what you can understand, successful investing follows a process and not emotions. So, if we follow investment process, definitely our investing will become a successful investing because here we are not following any emotions. That is why we should know very clearly that investment is not gambling, it follows scientific process. See, what are the factors to be considered for deciding our investment options? So first we will see our risk appetite. Here we have to understand what type of investor we are. There are three types of investors. Conservative investor means who avoids high risk. He prefers to have safety and he wants stable and regular income. Means he is ready to accept low returns. So what type of investments he prefer to have? He prefer to have bank deposits, government securities, bonds, and insurance schemes. Now coming to the second type of investor, moderate investor, means he accepts moderate risk. He wants to have balanced safety and returns. Means here he is interested to invest in mutual funds, a combination of shares and bonds. He is moderate risk taker. Next, coming to third type of investor, he is aggressive investor. Means he is ready to take higher risk. So when he is ready to take higher risk, he can expect high returns also. So he focuses on what? Capital appreciation, and he usually invests for long term. So what type of investments he prefer? He prefer to have equity shares, derivatives, cryptocurrency, and he also shows interest investing startups. So what you can understand with this, conservative investor wants to take less risk, so definitely less returns. And moderate investor want to take medium risk, so medium returns. And aggressive investor wants to take higher risk, so higher returns. So this is about what? Risk appetite. Now coming to mode of investment. So what type of investment you want to make here? You should have that clarity. Whether you want to go for equity shares or preference shares or bonds or mutual funds, bank deposits, or you want to invest in physical assets like gold, silver, etc. Right? Now coming to the third one, return on investment. So what return you are expecting, whether you want to have higher return or medium return or lower return. So based on your return on investment, you will choose investments. Next, what are your financial goals? See here, as an investor, you may have different financial goals like construction of your house, or children education, or your retirement plan, like that. Every investor has to think before what are his financial goals. And rate of inflation also you have to check before making any investment. So here in this investment process, here you can see goal setting, risk analysis, portfolio design, implementation, monitoring and adjustments, and periodic portfolio review. This I will explain using this chart. See here you can see investment process. Here there are how many steps? 5 steps. One is first one is investment policy, second one is analysis, third one is valuation, fourth one is portfolio construction, and fifth one is portfolio evaluation. By using all these steps, we'll make investment process. I will explain this investment process in detail now. So what is our step 1 investment policy? So here the investor will have some objectives, for what purpose he want to make investment and what are his available funds. See, when he earns some income, after meeting all his expenses, whatever the funds that are available with him, that are called available funds. And what is his risk bearing capacity? What I have explained now, that is conservative, medium or moderate, and aggressive investors. So this risk bearing capacity also will help us to decide about our investment policy. So all these three we have to consider before making our investment decision. This investment policy will act as a roadmap before we make any investment decisions. So what are the important elements we'll cover here? We'll discuss about investable funds, objectives, and knowledge. So here in investment policy, I want to give one example. A salaried employee, he wants to invest for his children education every month 10,000. So this is one type of objective for him for making investment, and also he will make planning for his retirement. So here I want to give one tip to you. Always invest only your savings, but don't invest your emergency money. See, if you see this slide, you can understand that whatever the income you will get, that income you will use to make some major purchases, education purpose you will use, real estate, you will use for insurance, and also you will use for making tax payments, right? So like this you will see what is your income and for what purposes you have to spend your income. So if you take example of this family is having different needs, want to use their income for education purpose and for their retirement and for their health needs, and also they want to make investments for future purpose. So what are the financial goals that are listed here? Building emergency fund, pay off debts, whatever the debts they are having till now, they want to pay the debt, that is also their financial goal. So make payment of this debt also, they can make some savings. Next, plan for retirement and save for education. These are all what? Financial goals. Next, coming to investable funds. The entire process, the entire procedure revolves around the availability of investable funds. So the funds generated may be through savings or sometimes through borrowings. So if we are investing using your savings, how you will make savings? You will invest only the surplus money after meeting all your regular expenses. See here I gave one example. If a person's salary is 60,000, so whatever the expenses he has to bear, that expenses are 45,000. So how much is remaining? 15,000. That 15,000 he can make investment, right? Say if the investor want to use borrowed funds for making investment, then he has to be very carefully plan this, because always his return should be more than his interest on borrowings. Here I want to give one tip, that invest only surplus funds, not emergency money. That is a wise investment decision. Second one is investment objectives. So what are the investment objectives of an investor? He want safety of his capital, whatever he invested in the investments. And he also want regular income out of his investment. Say for example, like if you have invested in buildings, you will get regular income as rent, or if you have invested in fixed deposits, you will get regular interest. Next, third one is what? Capital appreciation. Suppose if you want to increase the value of your investment, then invest in long-term investment so that you will have capital appreciation. Say, for example, you have invested in shares, or if you have invested in land or buildings, you will have what? Capital appreciation. Next, what is the other objective for making investment? Liquidity, because whenever you want any money, so that you can easily convert that into cash. Next, tax benefits. See, for tax benefit purpose, you will invest in tax saving funds, right? So these are all different objectives of an investor. Next, you can understand here that young investors generally prefer growth. That is why they invest in long-term funds. But if you take the example of retired investors, they want safety of their money and they want regular returns. So like this, investment objectives will be differing from investor to investor. Now coming to the third important point under investment policy is investment knowledge. So investors should have good knowledge, good understanding about market conditions, right? Next, investor should know various investment alternatives like shares, bonds, debentures, fixed deposits, mutual funds, gold, silver, real estate, cryptocurrency, etc., etc. Right? Next, investors should understand clearly what is risk and what is return. If he is selecting one investment option, he should know what is the risk he has to bear to get particular percentage of return. He should also have good knowledge about stock markets and their operations. See, here we are having BSE, means Sensex, and NSE Nifty. So this all I will explain in future videos. Here I would like to quote one example. Before investing in shares, understand company performance and market trends. So don't invest blindly in any share without having knowledge about the company's performance and that particular market trend. Now coming to the second step, analysis. Here we will analyze economic conditions, industry growth, and company performance before investing. So analyzing about economic conditions is called what? Market analysis or economic analysis. And analyzing about industry growth is called what? Industry analysis. Next, knowing about the performance of the company, what we'll do, we'll make company analysis. This we will discuss in detail. So like this, we have to make analysis of economy, industry, and company to have good knowledge about our investments. So this is called what? Fundamental analysis. Now, first we'll know about market or economic analysis. In this, we have to know about inflation, interest rates, and our GDP growth and other market trends. So this will definitely help us to know what is our economic scenario. Now, this economic analysis or market analysis will also help us to know what are favorable investment conditions and what are risky investment conditions. So based on that, this will enable us to know when to invest our money in the market. Here we can also understand investor sentiments and what are the government policies that are affecting markets. See, if there are any changes in government policies or government rules and regulations, that will definitely affect the markets. So we have to see about this also in detail. Next, strong economies usually support higher investment growth. If the economy is strong, definitely it will support higher investment growth. So we have to check what is the present economic situation. If the economy is not favorable, then it's not the right time to make investments because we can't expect higher growth. If you make industry analysis, you can evaluate the future growth opportunities in industries. This industry analysis will help us to study the demand, competition, innovation, and what are the rules and regulations of government on this particular industry, and what are the opportunities and challenges of that particular industry. Suppose if you want to make investment in petrochemical industry, so here you can check what is the competition, what is the demand, and what are the new rules and regulations, and what are the opportunities and challenges that particularly happening in that particular industry, right? So here I would like to give an example. EV industry and AI and digital transformation sectors. Say if there is good scope for renewable energies, then definitely EV industry will be having good growth. Next, if there are good digital services available in the market, then there is a great opportunity for AI and digital transformation sectors. So IT companies grow when digital services demand increases. So this industry analysis is more helpful for us. If you are selecting a company, that company is strong, but it is in a weak industry. You have to think before making investment in that particular company. Next, company analysis. So company analysis means here, say for example, if you take one company, you have to check what is their profitability and what is their sales growth. You have to see the trend analysis, right? And what is the company's debt position. And also we have to see capital structure of the company. What is the proportion of equity and debts? Study about management quality. We should also have some information about their future business plans. So this will definitely help us to know whether that particular company is financially strong or not. We'll make analysis of different companies like TCS, Infosys, Wipro, Amazon, Flipkart, Uber, etc. Now coming to third step, valuation. See here, we have to value the real worth of securities. This will help investors to identify whether the shares are undervalued or overvalued. So to check this, first of all, what we should know about the intrinsic value, means the real value of that particular share. See here, actual worth of a security based on fundamentals. Example, intrinsic value of your share is 1200, means this is the real value of your share, right? And the market price is 950. Because the worth of the share is 1200, but it is quoted in the market for only 950. So what is our option? Buy that particular share. Grab that opportunity, buy that particular share, right? Because the share is undervalued. Vice versa. Say if the intrinsic value of the share is 800 and the market price is 1000, then what you will do? Don't buy that particular share because it is overvalued, because the actual value of the share is only 800, but it is quoted in the market as 1000 rupees. So don't buy the share which is overvalued. So this is called what? This is called valuation of share based on intrinsic value. Now coming to the future value and compounding. So here, what is future value? Means here, this future value will estimate the value of investments in future. Say for example, if you have invested rupees 1 lakh today for 5 years, and what's the interest rate? 10%. So how much it will become? 1,61,051 rupees. That is the future value of our present investment of rupees 1 lakh. So we should also make valuation of our future value of investment. Right? So here there is one formula also given in this particular slide. See that formula of compounding. So here I have quoted one point here. Compounding increases wealth over time. If you see this slide, you can understand if our principal value is 1 lakh and you are making investment for 20 years at the rate of 10% per annum. If it is simple interest, how much you will get after 20 years? Only 3 lakhs rupees. Means our 1 lakh investment after 20 years at the rate of 10% per annum, we are getting only 3 lakhs if it is simple interest. But if it is compound interest, how much you will get? 6 lakhs 72,000 we will get after 20 years. Means how much increase is there? Another 5 lakhs 72,000 is added to our 1 lakh rupees of investment. That is because of what? Because of compound interest. So you value your investments using future value so that you can understand how much good value of returns you will get in future. Next, portfolio construction. So what is portfolio construction? You have to select investment avenues very carefully. Don't take all risky investments. So you balance. You take high risk investments and also take low risk investments. Why? Because if you take shares or high risk investments, if you take all shares, what will happen? Because there is higher risk, you may get higher return. But you remember, you have to take risk also. So don't take high risky investments only. So you balance your portfolio. See here, I would like to give one example. Don't put all eggs only in one basket. So you select high risky investments, moderate risky investments, and also low risky investments. So this will definitely minimize your risk and maximize your returns. So this diversification will reduce what? Our portfolio risk. What are the main elements that we are going to study in portfolio construction or portfolio diversification and allocation of funds among different securities? So is it clear about portfolio? What is portfolio? It means we are selecting different investment avenues like equity, gold, mutual funds, bank deposits, etc. I will explain about diversification. Investing in different assets means here you are investing in shares, bonds, debentures, mutual funds, fixed deposits, gold, silver, land, right? Like this, you will invest in different assets. This will reduce your risk in the loss of capital and also income. So here I gave you first diversification, what? Debt and equity diversification. If there is a debt, then you will get less interest, but at the same time you will have stable returns. Means your risk is also less. But if you take equity into consideration, your returns may be high because you're taking more risk. So you have to make debt and equity diversification and see that the risk is minimized and returns are maximized. Next, industry diversification. What is industry diversification? Don't invest all your money in only one industry. Diversify your investments. So where you have to invest some amount, you invest in banking industry, some amount you invest in IT industry, some amount you invest in pharmaceutical industry, some amount you invest in construction industry, some amount you invest in iron and steel industry. You can also invest in FMCG industry, sugar industry, oil industries, right? So like that you diversify your investments. Next, company diversification. What is company diversification? In one company, you invest not only in one particular type of security, invest in different types of securities. Diversification, if you want to make 100 rupees investment, invest 40 rupees in equity, 30 in mutual funds, 20 in gold, 10 in bank deposits. Like this, you can diversify your 100 rupees of investment into 4 different types of investment avenues, right? So what I have quoted before, do not put all eggs in one basket. So diversify. So this, what is the tip, investor tip? Diversification helps reduce overall investment risk. So our overall investment risk will be reduced when you diversify. So here I want to show you one picture. You can see here they have invested for 10 years, right? So 10% they have invested in money market instruments, and 15% they have invested in high yield bonds, and in medium term government bonds they have invested 15%, and gold ETFs 10%, and growth oriented small cap 30%, and value pick large cap investments they have made how much, 20% investment. So like that they have covered all their 100% investment into different types of securities. So like this you diversify your investment. So here I have told you, no, sector diversification means investing in different types of sectors. So how many sectors are given here? Healthcare, real estate, technology, manufacturing, agriculture, technology, travel, energy sector, retail sector, real estate, finance. Like this, you diversify your investment into different sectors. Next, selection and allocation. You have to select particular investment or security and decide how much of proportion you want to make, right? For example, if you are having 10 lakhs rupees with you, you decide how much you want to invest in gold, how much you want to invest in shares, how much you want to invest in mutual funds, how much you want to invest in bank deposits. Like that you decide and select investment proportions. So here I would like to give an example. Young investors, they want to have higher equity allocation, because in short term uh, prices may vary for shares, but if you invest for long term, definitely there will be appreciation. That is why young investors choose higher equity allocation. But if you take the example of retired investor, they want to invest in fixed deposits and bonds, because these are more safer and will give stable returns. So here asset allocation is made. See, 57% they have invested in debt, 6% in gold, 11% in real estate, 26% in equity. If you see this debt equity proportion, debt they have invested 15% and 85% in equity. Like that, investors will choose asset allocation for making investments. Next, portfolio evaluation. This is the final step of our investment process. So in this portfolio evaluation, we have to regularly review our portfolio performance. See, once you have invested, don't just leave that. So you have to review regularly what's happening to our portfolio. You should compare with our expected returns with the actual returns. Say you have expected some 12%, but the actual returns are around 8%. So if there is any variation, you have to observe that, right? Next, identify weak performing investments. So if you observe any weak performing investments, then immediately what you should do, you have to withdraw funds from that weak performing investments and invest in other investments which are performing well, right? So revise portfolio to improve your returns and also to reduce risk. So if you do this portfolio evaluation, then what will happen? Your returns will be improved and your risk will be reduced. See how you have to make this analysis. See here they are making this analysis whether there is improvement in their investment, or is it having any downtrend, or the situation is in peak, or it is in contraction, or it is having any expansion. All these stages you can observe in our portfolio evaluation. Now, appraisal. Here, the return and risk performance of the securities varies from time to time. Sometimes the shares may be performing very well, then you will get good returns. Suppose if the shares market is down, then the share value may be decreasing. So you have to observe the changes that are happening in time to time, right? So this appraisal warns the loss, and steps can be taken to avoid such losses. You'll be cautioned about the loss, right? And immediately you can take steps to avoid such loss. There is one example. What amount of interest you have expected? 12%. But how much you have received? Actually 8%. So here what the investor should do, he should analyze reasons for poor performance of this particular share and make necessary actions. So here you can see investment performance of different investments. So like this, they will make appraisal, whether they are increasing or decreasing. If it is increasing, how much it is increasing. So here they have made analysis about equities, fixed incomes, private equities, annuities. Next, after making appraisal, what you will do, you will make revision. So this revision is important. Why? Because this revision will make us to replace weak investments and invest in strong investments. See, this review, this appraisal is not made occasionally. We have to make this continuously. Why? Because based on that only we will make revision of our investments. Next, continuous monitoring improves long-term wealth creation. So we have to make continuous monitoring. This will definitely make us to understand where we are standing. Next, low-yielding securities with high risk are to be replaced. For example, selling weak performing shares and investing in good performing shares. So this portfolio, whatever they have made, this portfolio is to be revised every time and they can set the percentages changes. Now, why investors prefer a structured investment process? So after understanding about the complete investment process, what I have explained to you, you can understand very clearly now that this will build our confidence and this will definitely give us good financial discipline. That is why we should have structured investment process, right? Next, risk management is possible here because of structured investment process. And if you want to have good wealth generation for long term, we need to have structured investment process. Whenever we want to make any investment decisions, that investment decisions are to be made with good knowledge about our investments. So this structured investment process is essential for both individual investors and also institutional investors. So here I want to conclude that smart investors follows a process, not emotions. So a successful investing means knowledge, planning, and discipline. Smart investing is not about quick profits. It is about following the right process with patience and discipline. So keep learning, keep investing wisely, and keep growing financially. Thank you for watching this video on investment process. For more videos, please like, share and subscribe and learn finance in a simple and practical way. So that's all for today, but learning never stops. We'll meet in the next video. Thank you.